Imagine buying your favorite stock at its lowest price every single time, without ever knowing when that moment will be. Sounds like magic. It's not magic. It's a system. People chase the dream of perfect timing, like it's a golden ticket. Every investor secretly fantasizes about catching the market at rock bottom, buying in right before prices explode upward, and selling right at the peak before the crash. It's seductive, the idea that one perfect move could make you rich overnight. But here's the reality check. Timing the market is not just hard, it's nearly impossible. Even professional traders with access to real-time data, sophisticated algorithms, and decades of experience fail more often than they succeed. The market is a living, breathing, chaotic organism influenced by countless variables. Politics, technology, consumer behavior, global events, even unpredictable black swan shocks. You can't outguess it consistently. This is where dollar-cost averaging DCA changes the game. Instead of placing all your chips on one bet, you spread your investment out over time, buying at fixed intervals no matter the price. It's the financial equivalent of walking through a storm instead of trying to predict when the lightning will strike. You may get rained on a little, but you avoid the disaster of betting wrong. With DCA, you're no longer the gambler at the casino table. You're the casino itself, running the house on a system that wins over time. Now, let's strip away the financial jargon and look at this in real terms. Imagine you decide to invest $500 every single month into a specific stock or an index fund. Some months that $500 buys you 20 shares because the price is low. Other months, it only buys 10 shares because the price has risen. Over time, these purchases average out. When the market drops, you're not panicking. You're actually getting more shares for your money, like a buy one, get one free sale. When the market soars, you're buying fewer shares, which naturally prevents you from overpaying too much at inflated prices. This averaging effect quietly builds a portfolio that is resilient, balanced, and far less exposed to the risks of volatility. You're not trying to hit home runs with every purchase. You're hitting singles and doubles, but you're hitting them consistently. Over time, those small, steady wins compound into something extraordinary. This is why legendary investors often say, time in the market beats timing the market. The DCA approach doesn't require you to be psychic. It only requires you to be disciplined. Discipline beats luck every time because luck runs out, but discipline compounds. The beauty of DCA is that it transforms investing from a nerve-wracking guessing game into a predictable habit. It's not flashy, it's structural. And in the financial world, structure is what allows ordinary people to achieve extraordinary results. Think of it like building a skyscraper. You don't throw up the entire structure in a single day because you think today's weather is perfect. You build it floor by floor, week by week, regardless of whether it's sunny or raining. Some days the progress feels slow, almost invisible. But over time, those small additions create something massive, unshakable, and awe-inspiring. The same applies to your portfolio. DCA is not about reacting to the market's mood swings. It's about ignoring them entirely and focusing on the one thing you can control, your input. When you commit to a fixed investment amount at regular intervals, you neutralize the risk of dumping your entire capital in at the wrong time. You embrace the idea that perfection in timing is a myth, and that progress, steady, unstoppable progress, is the real key to wealth. Markets will rise and fall, but your strategy remains steady. That's not just power, that's mastery. Markets aren't machines, they're reflections of human emotion amplified 1,000 times over. Every tick up or down in a stock price is a vote of confidence or fear cast by millions of people reacting to news, rumors, and gut feelings. When markets are booming, greed whispers in your ear, buy more now, Don't miss out. When markets are crashing, fear shouts even louder. Sell everything before it's too late. This emotional pendulum is what causes most investors to underperform, not the lack of intelligence, but the lack of control over their own instincts. Enter dollar cost averaging, the great emotional equalizer. By committing to invest the same amount at fixed intervals, you remove yourself from the adrenaline-fueled decision-making that wrecks so many portfolios. You are no longer sitting at the steering wheel, jerking left and right every time the road bends. You've set the cruise control, and you're letting the engine do the work. The market's wild mood swings stop dictating your actions because you've already decided what your next move will be months in advance. Think about what happens during a market crash. News headlines scream about historic losses and financial collapse. Social media floods with panic. Investors sell off in droves, pushing prices even lower. This is where emotional investing destroys wealth. People lock in their losses out of fear and then miss the rebound. DCA flips that behavior on its head. If you're following a fixed investment schedule, a market crash doesn't send you running. It makes you lean in. Prices are down. Great. Your scheduled purchase this month will buy more shares than usual. Instead of seeing red on your portfolio and thinking, I'm losing, you're thinking, I'm buying at a discount. This is a radical shift in perspective, and it's only possible because DCA removes the need to make an emotional choice in the heat of the moment. You're not debating whether to invest. You're simply following the plan you made when your head was clear and your judgment was rational. This kind of pre-commitment is powerful because it locks in good behavior before fear or greed can hijack your brain. Here's the deeper truth. Market volatility is not your enemy. It's your greatest ally if you know how to use it. The problem is that most people treat it like a threat to be avoided. Volatility is simply the market's way of adjusting prices to reflect new realities, and those fluctuations are where opportunity hides. With DCA, every dip becomes a buying opportunity automatically, and every surge is just another part of the ride. You stop trying to fight the waves and instead use them to propel you forward. It's like surfing. You can't control the ocean, but you can control how you ride it. Emotional investors wipe out because they panic when the water gets rough. Strategic investors, armed with DCA, ride straight through the turbulence, knowing the long-term destination hasn't changed. In the end, markets reward patience and discipline far more than they reward speed and cleverness. By using DCA to strip emotion out of your investing decisions, you position yourself to win not just in good years, but in the inevitable bad ones too. In a world obsessed with speed, the idea of playing the long game feels almost rebellious. Everywhere you look, people are chasing quick profits. Day traders glued to their screens, crypto speculators hunting the next moonshot, influencers bragging about overnight gains. But here's the truth no one wants to admit. Most of these fast wins are short-lived, and most of these players burn out. Building wealth isn't about racing. It's about enduring. Dollar cost averaging thrives in this space because it doesn't promise instant gratification. It's the opposite, a slow burn strategy designed to quietly accumulate power over years, even decades. That's the secret. While everyone else is trying to light fireworks, you're building a power plant. The fireworks are bright for a moment. The power plant keeps running for generations. When you commit to DCA, you stop thinking in days or weeks and start thinking in decades. And in the world of investing, decades are where the real magic happens. The engine behind this magic is compound growth. Compounding is deceptively simple, yet unbelievably powerful. It's the process of your investments generating earnings, and those earnings generating more earnings. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, growing larger and faster. The catch is that it needs time. Most people underestimate just how much time amplifies the effect. They quit too early or try to outsmart the system, breaking the compounding cycle. Dollar cost averaging keeps the snowball rolling without interruption. Because you're investing consistently, the snowball doesn't stop growing, even when the market temporarily melts part of it away. Every contribution you make, whether during a boom or a bust, feeds the compounding machine. Over 10, 20, or 30 years, this steady stream of investment becomes an unstoppable force, and the results can be staggering. The difference between someone who invests sporadically and someone who sticks to DCA isn't small, it's exponential. And here's the part most people overlook. The long game isn't just about numbers, it's about resilience. Over decades, markets will face recessions, crashes, wars, political upheavals, and technological revolutions. The impatient investor gets whiplash from every twist and turn. The long game investor absorbs it all and keeps going, because the goal isn't to avoid storms, it's to outlast them. Dollar cost averaging is built for exactly this kind of environment. It's a strategy that assumes chaos is inevitable and still finds a way to win. By spreading your investments over time, you're naturally buying through every kind of market weather, which means you're never fully exposed to the worst moments, nor dependent on the best moments. It's like running a marathon in a world where everyone else is sprinting 100 meters at a time. You don't need to be the fastest, you just need to keep moving. And when the decades pass and the dust settles, you'll find that the steady, disciplined, long-term investor is the one holding the trophy, not the sprinter who burned out halfway through. In the end, wealth isn't built in moments, it's built in movements. Dollar cost averaging is more than a strategy, it's a philosophy of persistence in a world addicted to instant results. While others gamble on luck, you're building certainty. While they try to predict the future, you're shaping it, one consistent decision at a time. The market will rise, it will fall, it will twist and turn, but your path will remain unshaken. And one day, without fanfare, you'll look at what you've built and realize the truth. You didn't need to time the market. You just needed time in the market, and you made every second count. If you found this video helpful, hit the like button, subscribe, and turn on the bell icon so you never miss an update.